started, and I'm sure other people will join through the process, but I'm going to jump on and chat through a couple of things. FYI, for whatever reason, the chat box, we're having some issues with the chat box. So if you have questions or when we talk about questions, drop them in the Q&A. And there should be an area where you can drop them in the Q&A and we can chat through some of those things there. Um, but just wanted to get started and talk about some of the issues and some of the challenges that are upon us here in San Diego right now. So, before I dive into some of those things that we're going to chat through, if we haven't had the opportunity to meet, I am Danny Drysdale. I'm the director of sales for Intercap Lending here in California. We brought Intercap Lending to California just about 6 years ago, almost exactly to the day. And since then, our team here in California has done about $1.2 billion in volume. So, out of our San Diego connections. So in that sense, we have done a lot of business and we know our way around a lot of the challenges that you guys are facing in real time as we've gone through and moved through things over the last 6 years. Just a heads up, my one of my members of my team, Megan, is going to be managing and kind of monitoring that Q&A box so that we can chat through some of those things. And if you have any questions, we want to make sure that we get to them. But there's also some questions at the end. We want to make sure that we're sensitive of everyone's time. So there will be a little bit of time at the end to answer some more general questions. If you have specific questions about an actual deal or a specific community you're interested in, let's dive on a separate call that we can chat through things in a little bit more detail and dive into things further. So I do want to spend a lot of today talking about the current issues at hand, which are really underinsured communities, excluding wildfire coverage in master insurances, underinsured communities, and then the big balcony inspections, SB 326, and how that has blown up some transactions for all of us, unfortunately. But how are we able to navigate some of those things a little bit differently? How can we make you look amazing to your clients? And how are we able to make sure that we get any deal that can possibly close done? If there is a way to do it, we can definitely do it, and we'll explain why, and we'll explain how you can shine and how you can stand out to your clients. So, want to just kind of chat through some of the things that we are going to cover today. One of the things I do want to touch on real quick is just the difference between a limited review versus a full condo review. So if you've been around the business for a little bit, you've probably heard that difference. Have you guys heard those differences between a limited review and a full condo review? What makes that difference, and why does that matter on the lending side of things? That can help you understand, especially if you're on the listing side of things, which offers to accept or which ones to take more seriously, depending on what's happening in that community. We want to talk about obviously the differences of conventional FHA and VA condo requirements and what needs to be reviewed or not reviewed based off of what type of loan you're using. We're going to talk about the master insurance challenges and the wildfire insurance and some of those things that we're dealing with right now. And then, like I said, the big balcony bill. And we're going to touch briefly on non-warrantable condos and non-QM loans. There's there's a lot more detail when it comes to non-warrantable condos. And if you guys are finding this information valuable at the end, if you'd like to have something that goes into a little bit more of a deep dive to condos 101, condos in general, please let me know and we can chat and we can dive into some of those things and we can set up another time to talk through what other challenges you come across when it comes to some of that stuff. We want to make sure that you save more deals, that deals don't go sideways, and we want to help you do that. So as we talk through a lot of these things today, it's good to take notes. It's good to kind of get an idea of what we're talking about so that you are more knowledgeable, but don't expect, and we don't expect that you are the master when it comes to some of these things. This will help you shine and look better with your clients, but let us be a resource to help you really, really stand up above the crowd. So we want to help you and understand how you can help your sellers and their listings, how you can help with your buyers, and how we can avoid some of these issues before you even run into them in escrow, things like that. Now, why did all of this kind of come about? Um, this obviously that's not a pretty picture, and we don't ever want to see a condo collapse. This is the Surfside condo community in Florida. It collapsed in June 24th of 2021. The reason for the collapse, in full transparency, that was a community that a lot of owners that lived in that community were not owner occupied. They were renting it out as vacation rentals. The owners who actually owned the community, owned the properties in there, didn't want to put a lot of money into the maintenance of the community. So there was a lot of deferred maintenance. There was a lot of issues there that they just kept neglecting. Well, it created a major issue. And in that situation, it caused Fannie Mae and Freddie Mac and Ginnie Mae, who I'll kind of talk about a little bit through this process, it caused them to basically take a second look and a deep dive into how they're viewing and analyzing their condos. So that a new questionnaire came out in December of 2021, about 6 months after that specific incident happened. A new condo questionnaire came out. Now, have anybody use the Q&A box because I think the chat is disabled, but has anybody ran into any issues over the last year or two? Have you ran into any issues where you're not able to get a condo community, maybe a deal falls apart or says that financing isn't eligible or any of those kind of things? Let us know if you're seeing some of those issues. I actually can't see the Q&A, so Megan will let me know if there's anything that comes up that we need to chat through. Um, like I talked about, the new questionnaire, the focus on the special assessments, that new questionnaire that came out in 2021 in December really focuses on those deferred maintenance issues. It kind of highlights those of making sure that those communities don't continue to deteriorate. And then obviously the SB 326, as of the beginning of this year, that's effective through all of California with certain balconies. And we need to figure out how to navigate some of those challenges. Just so you know, as we dive into this, all of this information is going to be current and up to date, but this is going to be based off of today, information available today. The MBA or the Mortgage Bankers Association is actually having their condo lending summit right now, this week on the East Coast. The head of our condo department is there. He's actually going to be presenting in a couple of small groups and talking through a couple of things. He's going to be bringing up some other things that they're going to be chatting about. Fannie Mae and Freddie Mac, the Mortgage Bankers Association, is going to be looking at these things and they're trying to figure out how to navigate this stuff. This other picture that you see here, this was another condo community in Florida. Hopefully, fortunately, these aren't in California, but it's another condo community in Florida that was a support beam in a garage, and that was on May 6th of 2025. The community got evacuated. It was an unfortunate situation. Those things are ongoing and those things continue to happen. So let me, as we move through this process, there might be different things required or different information available in 6 months or a year from now, and we'll help you navigate those as those come up. Um, Want to dive into limited versus full condo review. Now, the difference between those two things is when there is a limited review, there's less scrutiny. There's no review of annual budgets. There's the owner occupied requirements. There's some issues. You don't have to look at the owner occupancy rate. Now, there's a couple things to note with owner occupancy. One, if you're buying it as a primary residence, you never worry or never have any issues with owner occupancy. We've seen where other lenders have actually turned down or got into trouble or said that they can't do a loan because the occupancy rate is greater than 50%. The non-occupancy rate is greater than 50%. Now, that isn't necessarily true. You actually can do a limited review of those situations as an investor looking to buy in a community. And if you have a certain form filled out, you can go about it a different way where it doesn't address the occupancy rate. You can still do regular, conventional, traditional financing in that situation. Um, when it comes to primary residences, if you're buying it as a primary residence, a limited review is triggered on a conventional loan when you have more than 10% down. On a second home or investment property, it's when you have more than 25% down. So, just trying to touch base when it comes to those items. That will help you as you're looking at if you have buyers interested, if they have more money to put down, it's definitely going to help make condos and financing for condos in this current market a little bit easier. Um, Now, what is the difference and what is required different on all of those? So obviously with primary residences, you have conventional loans, you have FHA loans, you have VA loans. You can use those all as primary residences, right? FHA, VA specifically is only for a primary residence. Now, in that situation, obviously there's less money down required. And when you're buying as a primary residence, there's more loan options available, and there's different things that we have to kind of adhere to when it comes to that. As far as the investment occupancy, the investment, um, if you're looking to buy it as an investment property, you're going to have more money required down. And there's going to be some additional lending guidelines. So that can change how we're viewing some of that as well. Now, if you ever have ran into somebody saying that the investor concentration, there's more investors in that community, like I said, there's a short form that can be completed. It may cost the HOA, they might charge an extra 50 or $100 to complete that form, but there's a shorter version of things that don't address that. Now, if it gets brought up in the appraisal, then in that situation, all we're doing in the appraisal is making sure that the appraiser notates that he's basing this information off of mailing addresses. So there's a way to get around any of that. You can buy an investment property all day long in a community that's over 50% investor occupied. So don't let that be something that deters you or your clients if they're not sure how to kind of navigate some of those things. Now, I don't know if you guys have heard this. I don't know if the Q&A box is working or the chat, but if has anyone heard or has anybody ever told them that they can't get financing because it's on the Fannie Mae ineligible list or it's on the Fannie Mae do not lend list? Fannie Mae and Freddie Mac have their own systems. Fannie's is called the Condo Project Manager, or we refer to it as CPM. Freddie has Condo Project Advisor, CPA. Fannie Mae's is a lot more in depth. They started it a long time ago. There's more in it, and Fannie kind of analyzes it a little bit differently. So there's actually what's happening in the current environment is as things are coming up and as issues are coming up with SB 326, if Fannie gets wind of those, they will put them on their unavailable list. Now, that doesn't mean, I don't know if you guys are nerds like me and watched Monty Python and the Holy Grail when you were young, but you're not dead yet if that is the case. There's no issues if you have if you're on the unavailable list, there are still options with financing. If somebody's telling you that, they probably aren't as knowledgeable or as experienced as they should be when it comes to lending in this current environment. So let's have a conversation about that because those are some things that can definitely help save some deals if somebody's saying that that presents an issue. Just means we have to look at it a little differently. Now, FHA, this is an interesting thing because we're in a unique time right now where FHA and VA might actually be better deals, better offers to write, and better deals to accept if you're on the listing side of things. Here's why. With FHA, and we'll dive into VA in just a second, but with FHA, there's a completely different form that needs to be filled out. There's only 3 sections of the form that need to be completed. It doesn't ask a lot of those information, a lot of that other information. If it's FHA approved, we can work around a lot of those different issues that you're running into. So even if you structure an FHA loan, there's things with an FHA loan. Yes, there's, required mortgage insurance and different things like that. But even in that situation, you could actually still get in a good scenario and in a good position. Even if you put more money down, you have a great interest rate with FHA, and it might be able to help you keep the deal on track doing an FHA loan. Now, you can actually do a single unit approval, and even if it's on the Fannie Mae do not lend list, you could get a single unit approval through the FHA and get that transaction closed. There's a process of reaching out and going through that process to make sure that we do that. But there's fewer questions. We can reach out to the Hawk or the Homeownership Center, which is up in San Francisco, and get a single unit approval for a community to make sure that we can get that done and that your client can buy in that community, even if it's not FHA approved. Now with VA is actually better and even easier than FHA in this world right now. If it's approved, if your community is VA approved, there's no questionnaire required. Nothing has to be filled out. We're not looking at the SB 326 balcony inspection. We're not dealing with any of that. The only thing that needs to be reviewed is the master insurance. There needs to be adequate master insurance, but other than that, there are no other issues. So if you are lending in a community that has maybe some other challenges, going VA is a great route to go. Now, I don't know if you guys know this, and I don't think we can work it out in the chat, but even if your condo was rejected by the VA previously, it is not VA approved and it was rejected at a prior time, a veteran can still use their VA benefits to buy in that community. There is a process. We help them navigate this, but ultimately we reach out to the VA. We explain that they are aware that the community they are in has been rejected, but they still want to use their VA benefits. They explain that there's compensating factors. It's a great school district for their kids. It's a wonderful community. It's multiple different things will help do that. The VA says that they can take up to 10 days to approve that. We're seeing that in 3 to 4 days. So even in communities that aren't VA approved, your buyers can still buy VA loans, and that can help get around some of the other issues that we're dealing with when it comes to other challenges with financing right now. For the VA Regional Loan Center, or the RLC, we call it, it's down in Phoenix, Arizona. We're talking with them almost daily at this point. So just kind of chatting through insurance as a whole. Here's the big thing and a big kind of myth with insurance and what's going on with insurance right now. Insurance has gotten more expensive. With every community, whether it's a non-warrantable community, whether it's a non-warrantable condo or a non-QM loan, whether it's a FHA, VA, conventional, there always needs to be adequate insurance. Now, we can help make sure that there is adequate insurance in communities. We know and understand how to look at and analyze an insurance policy to make sure that it has what's needed. What's been happening as prices of insurance in California have been getting more expensive, we have actually been able to, as prices are getting more expensive, I apologize, the communities are accepting lower insurance coverages, not realizing that it's actually hurting the owners of that community, that they can't finance or they won't be able to sell their homes in that community. We can help them get through that process. We have 2 different insurance agents that we work with that are vetted, that very much know and feel comfortable with these challenges, and we can help them update their master insurance, usually at a cost even lower than they're doing before, with the amount of coverage that they need. What you're looking for with master insurance is that it has guaranteed or extended replacement, that there's a replacement cost estimator associated with it. Some of those things are really good highlights and things to think about if you do see master insurance. Please send it to me and my team. We'll help you navigate all of that. What we're seeing in the California market, obviously, is they're underinsured. They're accepting those and not, they don't have enough coverage. From their perspective, they're going, well, yeah, we're not going to have something that hurts all condos at the same time, but it does, in the eyes of financing, create an issue. So something else that we're seeing is they're changing the payouts of certain things rather than guaranteed replacement or extended replacement costs. They're paying them out on cash value. Those are some trigger words or some red flags that you want to look for. Cash value is not adequate as far as replacement cost. So all of those things are things that you kind of look at. When it comes to wildfire, we're seeing that in every policy, there's a minimum amount of wildfire coverage included. But we're seeing that in the wildfire, in a lot of the new policies that are coming up, that they're excluding wildfire coverage, which means that they have to go out and get a different policy, and they're then dealing with a different set of challenges um, as you have wildfire coverage. Now, if you're dealing with wildfire coverage and it's excluded from your policy, there's a couple things that can happen. One, you can look at the CCNRs and you can see if the owners are able to get their own coverage through their own HO6 policy. Sometimes the CCNRs say that they're not able to do that. We can talk with the board, we can talk with the head of the HOA and help them explain that this would be beneficial in this time. And we've had people change their CCNRs in that situation. The other thing we can do is there is a calculation when it comes to wildfire insurance that a lot of people aren't aware of. There's been insurances that are astronomical deductibles when it comes to wildfire. There's a formula that can be used that you take the amount of the deductible times the number of units, and if that amount is below 5% of the total coverage of the community, then you're good to go. That's a lot of numbers. I don't expect you guys to remember all that stuff, but there's ways to work around some of those things. So we can help. If you come across communities or you know of any communities that have issues when it comes to insurance, please reach out to us because I can get them in contact with two insurance agents that will make sure that they're in a very good situation and they get better coverage, usually better coverage at even a lower price. Now, I know we're not going to do a deep dive into non-warrantable, but I do want to make sure that one thing a lot of people have kind of thought about, oh, well, we don't have enough insurance coverage, so it means it's non-warrantable or can't go regular conventional or can't do a traditional loan. We need to do a non-QM loan. Now, although each non-QM investor has a different appetite for what they require as far as insurance coverage, you need to have somewhat adequate insurance coverage, even with a non-warrantable or to go non-QM. Um, even in those situations, they're going to need that. So underinsurement, having something be underinsured in this community or in this situation is a big challenge. We want to make sure that we're helping people right size that. As you come across those communities, let's correct that because insurance policies for master insurances go for a period of 1 year. You could look at something and somebody could have closed a loan in June, but if their policy took place and their new policy is July 1st, we're based on that new policy and it could be different. We want to help people understand why those are different. Um, the other thing that comes up a lot, if you guys have been around San Diego, uh, been in the industry at all, you've probably understood that downtown, this is happening quite a bit in Sevita right now as well, but there's construction defect litigation. Now, even with construction defect litigation, it doesn't mean that you can't get financing or you have to go non-warrantable. There's some things that you have to look out for in that construction defect litigation, where they're at in the process, and what we can kind of do to help navigate through those challenges. With a little bit of help from the HOA, we can almost always get the information we need to know what exactly is possible and how we can navigate things from a financing perspective. Okay, so the SB 326, the big SB 326 are the balcony inspections. Um, this took effect in January 1st of 2025. All communities with balconies at 6 feet off the ground or higher, any balconies, they needed an SB 326 form. The technical verbiage was if they had balconies of 6 feet off the ground made of wood or wood-based products. Um, Wood-based products, obviously, uh, we're building homes. There's a lot of things made of wood, right? But in that situation, basically every community that has any balconies need an SB 326 form, that inspection. It's interesting because this law was actually passed in 2020 before the condo collapse in Florida. It's because there were some other issues. There were a few tragic balcony accidents here in California Then that happened in Florida and it kind of expedited that process. And that's why it's now a requirement that that is done on January 1st. And they're going to have an update on January every 9 years. Sorry, by January 1st, but every 9 years, they're going to have to redo that policy. That's why we see some SB 326 inspections that were done in 2022 or 2023. The time of that inspection is very important to us because it dictates how much work should have been completed. Now, when you look at an SB 326 policy or SB 326 balcony inspection, it can look daunting. It can look scary and like there's a lot of issues. At the end of the day, it's funny because if you think about it, you've probably had a lender at some point tell you in the past, like, we actually don't want to see the home inspection. You wouldn't want not necessarily so much the originator or the mortgage advisor, but the actual underwriter. We don't want to show the underwriter the home inspection. Well, the balcony inspection is a lot like a home inspection. And now Fannie Mae and Freddie Mac have forced us to show underwriters the balcony inspection. And so in that situation, a lot of regular underwriters aren't equipped to understand the gray area of what they will or won't take. How an SB 326 balcony inspection is broken out is it's broken out in basically by layers of urgency. So immediate, there, if this isn't addressed immediately right now, you're going to have some issues, or it needs to be addressed in the next 1 to 3 years. It's a it's a high priority, but it's not an emergency fix right now. Somebody's not gonna to fall through something, right? There's a moderate priority or low priority. It's either broken down by color or by number, 1 through 4, or different colors, all those different things. When you look at an inspection, I'm going to show you a couple different things. This is actually a copy of an inspection. So this is one page, obviously a lot of red, a lot of yellow. This was turned down by another lender that we did a loan in this community, did it as a regular conventional loan. I'll tell you how we did it. But if you look at some of these items, it's not the prettiest. You see some cracks, you see a lot of rust, you see a lot of different things going on. An underwriter might look at this and just be like, gosh, I don't know what they're going to risk, or I don't know what they're going to be willing to take on, right? Then you see some more rust on the handrails and the wood rot, and it looks really bad. You're looking, there's a lot of red and a lot of yellow, and it just looks scary, right? At the end of the day, the reason why we can get something like this done is because we actually understand San Diego's local market. What I mean by that is we understand the current conditions, our local climate, salt, humidity, some of those different issues that we deal with here that you may not deal with in other areas. We understand how building materials are impacted. And just because it looks rusty doesn't mean it's not safe. We understand that even though wood looks like wood rot doesn't mean it's not strong enough, right? There's certain things that it can look a lot worse in pictures. We've all seen pictures on MLS that look better or look worse. You can look through it and see pictures don't tell the whole story. So we have a deep understanding of some of those issues, some of those items that we can get through. The head of our condo department, he's at back east right now. He's at the MBA summit presenting. He is extremely experienced. He lives in Florida. That's where that condo collapse was. The other issue was, if there is a state worse than California right now when it comes to these issues, it's Florida. Fortunately for us, he understands both of those situations. He has consulted with Fannie Mae and Freddie Mac in the past. He's extremely experienced and he knows exactly what is needed when it comes to getting some of these things done. If your lending partner, if their headquarters is in Michigan or in different areas, Nebraska or the Midwest, and they don't have a full sense or full knowledge of some of these things, it can definitely present some issues as they're looking at this stuff. The other thing that we can do and that we take a different approach on is we have a bigger risk tolerance. One, we can put something in our own portfolio, even if it's insured by or guaranteed by Fannie Mae or Freddie Mac, we can service the loan. If you're working with a bank might not have as much risk, or a broker might have to be sending it to a certain investor and might not be able to to navigate some of those items, but we can actually service the loan ourselves, and we're willing to even sign an indemnification letter, and we have in the past. What that means is we basically tell Fannie Mae and Freddie Mac, hey, we guarantee this loan is not going to default over the next 5 years, and if it does, we will buy it back from you. That is a huge security blanket for Fannie Mae and Freddie Mac, where we can say, look, we're taking the risk on these situations. We can get some of these things done. We're going to take an aggressive approach. We know that somebody's not going to fall through this particular unit, even though there's a lot of red and yellow in the balcony inspection. Um, we have a flexible approach. Like I mentioned, banks or credit unions, sometimes they're really, really restrictive on what they want in their portfolio. Brokers, sometimes they don't know, or they know where they're going to go with that loan, but they may not necessarily understand exactly what that specific broker's requirements are when it comes to condos and how they interpret balcony inspections and some of those different items. So we're more competitive than most when it comes to some of that. Some of the things that we want to help you do with some of this, I know this is just a high level at this point, and I want to be able to make sure that we can chat through things. We don't have the chat working right now. Let's get on a call. Let's have some conversations through some of this. But one of the things we want to help you do is we want to help you stand out to people that you are helping. Like I said from the beginning, we want to help you shine. So when it comes to your buyers, we want to make sure that we're getting them pre-approved, and if we know that they're in a price point and they're probably looking at a condo, let's get ahead of that. And as they're looking at different communities and they're wanting to look at different properties, let's take a look and let's find out, is it on the do not lend list? Is it FHA, VA approved? Can we work through some of these things? Let's get a copy of the master insurance and the balcony inspection, because the listing agent should probably have those things, right? We want to help you do that so that you're not wasting your time showing your clients things that aren't going to work out. We're going to help you be able to put a list together and find a community that you can actually move forward with and be in a good situation. When it comes to the sellers, if you are taking a listing in a community that has some of these challenges going on, think of how much more powerful you are compared to your other agents or your competition. If you can go in and say, I've already had my lending partner vet this community. I know that there were some challenges in the past with when it came to the balcony inspections and the master insurance, but we've already reviewed, we've already approved. We can do financing as a regular conventional loan. We're not going to deal with some of those other issues that those other lenders couldn't figure out how to do. And so because of that, we can sell your house at a higher value, right? Some of those things are going to make you stand out and look very, very different when it comes to some of those items. Now, when it comes to that, if you have a seller or if you have a buyer, there is a questionnaire, a condo questionnaire, that every transaction with financing needs a condo questionnaire. It would help if we are able to review that first. If we can look at that first, we can order that. And the cost might be a couple $100s. We won't pay for that cost, but we will pass that. If you have sellers and they're doing that, it is definitely worth it to have that condo questionnaire completed so that we know what we have to do and how we have to navigate that transaction. And we will pass that condo questionnaire on to any lender in the future. We can use any lender's condo questionnaire, and they can use ours. So it doesn't have to be lender specific. It's a generic questionnaire approved by Fannie Mae and Freddie Mac and Ginnie Mae. So in those situations, let's get those done. Cost might be a couple $100s to get it completed, but it is well worth time spent for your sellers to make sure they have that up front so that we can run through those items. If you want us to do that even before you walk into the listing, you can pay for that cost. You can cover that cost yourself, and just ensure that you're going to get that listing because you've already done that homework. Um, we don't really have a way to do Q&A. It looks like there's not a way to do Q&A, and I'm so sorry about that. I wish, oh, you know what? I see the Q&A. I see the Q&A. Perfect. Um, I see a couple of questions in the Q&A box. sellers pay for a condo questionnaire, is there a time limit or is it good for? Like, is it like if the listing sits for 60, 90 days? That's a good question, Stacy. Um, the questionnaire is there, it is time sensitive. So it basically needs to be done within 120 days. And so, yes, if it sits for a long time, if it sits more than 40 days, it's not 30 to 60 days. So if it sits on the market for longer, if it's 4 or 5, 6 months, that might need to be updated at that time. But it is something that um, we can get updated and we can help get that updated as well. If the questionnaire most likely is not going to change. So looking at the initial questions, we'll take a look at that. And then knowing that that's probably going to be the same questions that happen down there, at least we've already navigated a lot of those challenges. Um, I I would love to I would love to connect on a couple other questions and a couple other things. If you guys have questions, please, and I'm going to share a slide. If you guys have questions, please, if you scan the QR code on the left, that will actually take you to an email that comes directly to my team that says condo questions in the subject line. We would love to answer any condo questions that you have. So please don't hesitate to reach out to us. If you want to connect on social media, I've been putting a lot of work into my social media lately. I'd love you'll get a lot of mortgage content. You'll see a lot of pictures of my cute kid because he's awesome, and so you'll get a lot of that too. But please, connect with me on social media. Um, the Calendly, if you want to get together, if you want to set up a time to do coffee or get together and chat in a little bit more detail about things, let's set up a time. I've got some time available on my calendar, so let's chat through those items and see what we can do to connect and maybe work together or navigate some of those challenges that you've ran into or whatever we can when it comes to some of these challenges. The last thing that I want to leave with you is we are, this is not specific, this is not condo related, but on August 5th, we are doing a class for a new program that we are bringing to the market. It pairs the purchase of solar with down payment assistance. It is going to be game changing. Even if the property has solar already, you can use this program. You don't have to be a first-time home buyer. There's no income limitations. You can get down payment assistance to go towards down payment and or closing costs. You can purchase solar basically at a wholesale cost, add it to your loan, add it to it, and get a percentage back towards your closing costs. It's going to be really, really incredible. And we're teaching a class on that on August 5th. So please come join us on August 5th. There's a QR code to RSVP to that. I'd love to see you guys there. And please reach out with any questions you have. I'm sorry that the chat box was not working, but I'd love to connect with you guys. Call me, text me. Let's talk soon. I appreciate you guys. We'll be in touch.